Take a $100 bill out of your wallet and look at it. The number on it will never change. A year from now, 10 years from now, it still says $100. And that's exactly what fools people. Because while the number stays frozen, the thing that actually matters, what that bill can buy, is quietly shrinking. That's inflation. It's not a headline that comes and goes. It's a slow, constant leak in the value of every dollar you hold. And here's the part that catches savers off guard. Doing nothing doesn't protect you from it. Doing nothing is how you lose. You can be the most disciplined person alive, never overspend, keep a fat pile of cash in the bank, feel responsible about it, and still wake up poorer every single year. Not because you spent the money, because the money quietly got weaker while it sat there. Ignoring inflation is one of the most expensive mistakes a careful saver can make, precisely because it doesn't feel like a mistake. Nothing breaks, no alarm goes off. The number stays the same. So today we're going to pull back the curtain on it. What inflation actually is, why idle cash is being taxed without you noticing, how fast prices really double, the trap that fools you into thinking you're winning. And finally, how to beat it. No panic, no jargon, just the mechanics. Let's start with what inflation really is, because the word gets thrown around like it's complicated. It isn't. Inflation is simply a general rise in prices over time, which means each dollar you hold buys a little bit less than it did before. Think about a grocery cart. Last year, filling it cost you $100. This year, that exact same cart, same items, same quantities, rings up at $103. You didn't buy anything extra. The cart didn't change. The price did. Your $100 now leaves you a few items short. Here's the key mental shift. Inflation isn't really about prices going up. It's about your money going down. Those are two ways of describing the same event, but the second one is the one that affects you. And a bit of inflation is completely normal, even intended. In a healthy economy, prices tend to drift up by roughly 2 to 3% a year. That's the zone the Federal Reserve actively aims for. It's not a crisis. It's the background hum of the economy. The problem isn't that inflation exists. The problem is that most people never account for it. They plan their savings as if $1 today will still be $1 tomorrow. It won't be. Now let's talk about where this quietly hurts you the most. Cash just sitting there. Imagine you've got $10,000 parked in a regular checking account, earning basically 0%. It feels safe. The balance never drops. But watch what inflation does to it. At roughly 3% inflation a year, your money loses about 3% of its real value. Its actual buying power. Every single year. Not the number on the screen. The number stays 10,000. But what that 10,000 can buy keeps sliding. Run that forward. After 1 year, your $10,000 buys what about 9,700 used to. Keep going year after year, and over a decade, that same $10,000 in idle cash has the purchasing power of roughly $7,400 in today's terms. You lost around a quarter of it, and you never spent a cent. This is why people call inflation a silent tax on cash. A real tax at least sends you a bill. This one just takes its cut quietly, automatically, with no paperwork and no warning. The money looks untouched. Its power is being skimmed away. The lesson isn't never hold cash. You need some. The lesson is that large piles of idle cash are not neutral. Sitting still is not the same as staying safe. Okay, 3% a year sounds small. So small it's tempting to shrug it off. To see why you shouldn't, we need a quick, almost magical shortcut. It's called the Rule of 72. Here's how it works. Take the number 72 and divide it by the inflation rate. The answer tells you, roughly, how many years it takes for prices to double, meaning your money's buying power gets cut in half. Let's plug in our normal 3%. 72 divided by 3 is 24. So at 3% inflation, prices double in about 24 years. Over a single working career, the cost of living can quietly double on you. Now watch what happens when inflation runs hotter. At 6%, you do 72 divided by 6 and you get 12. 12 years to double. So when the inflation rate doubles, the time to cut your money's value in half doesn't just shrink a little, it gets cut roughly in half too. That's the part people miss. Small changes in the inflation rate have huge effects on how fast your cash gets hollowed out. The rule of 72 turns an abstract percentage into a number you can feel. Years on a clock. Now, here's the trap. The one that fools even careful money-minded people into thinking they're winning when they're actually falling behind. Say you move your cash into a savings account that pays 1% interest. The balance ticks up. You see the interest land. It feels like progress, like your money is finally growing. And the number is growing. But the number is lying to you. Here's why. There are two kinds of return, and confusing them is the whole problem. The nominal return is the headline number, the 1% the bank pays you. The real return is what's left after you subtract inflation, and the real return is the only one that buys groceries. So to the honest math, you earn 1%, inflation eats 3%. 1 minus 3 is -2. Your real return is about -2%. Your account balance is rising, and your actual buying power is still shrinking. This is the most dangerous illusion in personal finance. A growing number convinces you you're safe, while the value quietly drains out the bottom. So the rule is simple but unforgiving. Always judge a return by what's left after inflation. Not the number the bank advertises, the number that survives. So, if cash loses and low-interest savings still loses in real terms, what actually beats inflation? Good news. This part is the most empowering of all. The answer is to hold things that have historically grown faster than prices. And the classic example is ownership in real businesses. Buying broad index funds that hold a slice of the whole stock market. Over long stretches of history, the stock market as a whole has tended to outpace inflation by a meaningful margin. Companies raise their prices, grow their earnings, and that growth has historically flowed back to the people who own them. You. That's the difference between a real return that's negative and one that's solidly positive. Cash sits there losing ground. The market, over time, has tended to stay ahead of the leak. Now, for money you'll actually need soon. Your emergency fund, next year's expenses. You don't put that in stocks. But you also don't let it rot in a 0% account. Park it in a high-yield savings account, which pays far more than a basic one. It won't make you rich, but it roughly keeps pace, instead of guaranteeing a loss. So the playbook is, invest long-term money to outpace inflation and use a high-yield account for short-term cash to stop bleeding. Idle cash is the only choice that loses by default. So let's bring it together. Inflation means prices go up, which is just another way of saying your money's buying power goes down. Historically around 3% a year. That makes idle cash a slowly losing bet, silently taxed without a bill ever arriving. The rule of 72 shows you the real stakes. At 3%, prices double in about 24 years. Don't be fooled by a growing balance. Judge your real return after inflation, not the nominal number on the screen. And to actually win, hold assets that outpace inflation over time, like broad index funds, while keeping short-term cash in a high-yield savings account instead of letting it erode. The single biggest takeaway is this. With inflation, standing still is not staying safe. Doing nothing is itself a decision, and it's the one that quietly costs you the most. Once you can see the leak, you can finally plug it. If this made inflation click, if you'll never look at safe, idle cash the same way again, hit subscribe. Because that's what this channel is for. The money stuff nobody ever bothered to explain. And since we just said short-term cash belongs in a high-yield account, that's exactly where we're going next. High-yield savings. Why your regular bank is quietly robbing you, and how to fix it in an afternoon. I'll see you there.